Today on Your Money, Your Wealth podcast number 513, YMYW listeners in their 40s are ready to call it quits at work, become financially independent, and retire early. Can they afford to do it? Peter and Joanna want to retire in the next 2 years. Burned out and ready to retire, wants out of his toxic office. If Maryland Chicken Man never earns another dollar, how much can he afford to withdraw from his retirement accounts each year? And Suzanne in Massachusetts is 69 and needs $60K a year for the next 30 years. Is she all right? Click Ask Joe and Big Al in the episode description to get a retirement spitball analysis of your own. I'm executive producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
Hey, what's up, Big Al?
Hey, aloha.
Yeah, in Hawaii, you're looking good, man.
Well, I'm more relaxed than typical, which should make for a better show. We'll see. Or maybe a worse show. I don't know. I have not had the Mai Tai yet. That's coming after.
Well, that definitely puts us in a better position.
So we got, let's see, from New Jersey. Greetings from New Jersey. My name is Peter. I'm 45, yo, and my lovely wife, Joanna, 44. We will both enjoy a good beer or two, usually a local IPA or seasonal. Together, we have 3 kids, ages 6 to 10. I've been listening for about a year. While I run to commute to work, I would love to spitball on my situation. Here's our breakdown. My total income is $350,000 per year. I have a company contribution of 8% and contribute the max of my Roth 401k. Joanna started a second career a few years ago and now has income of $75,000 per year. She contributes $500 a month to our 403b. As a state employee, she says she has paid health care that would contribute through retirement and will receive about 60% pension with inflated base COLA at 62. We spend about $100 or $10,000 a month. We'll have the following assets. So Peter, he's got $1.4 million in a brokerage account, $900,000. Okay, and an additional $900,000 in a Roth and additional $400,000 in a traditional 401k. Is that what?
Correct.
Why would he Okay, anyway. Joanna's got $100,000 in her brokerage account, $100,000 in her IRA, Roth IRA, $15,000 in a 403b, and then they have joint $100,000 cash. You got $700,000 house that's fully paid for, and a 529 plan that has about $500,000 in it for the kids. Wow, this guy's 45. And
Yep.
What has he got? Man, that's several million dollars.
It's about
$3 million. So
future income. Peter's expected Social Security at age 70 is $3,600 a month. Joanna's expected pension at age 62 is $5,000 a month. Joanna's expected Social Security at age 70 is $3,000. I'd like to explore retiring to take care of the family. Joanna will continue working until 62. Is it feasible to retire in the next couple of years? All right. So they spend $120,000 a year. And Joanna makes how much?
Yeah, she makes $75,000, Joe. And if you subtract out her 403b of $6,000 and taxes, I just estimated about $9,000. So maybe she nets about 60, right? So if they're spending 120 and she's making a net 60, so their shortfall is 60. You divide that into the 3 million they have, you get a 2% distribution rate, which for a 44 and 45-year-old, I'm okay with that if that's what he wants to do, even right now, not even waiting 2 years.
Would you take 2% out of your portfolio every year at age 45? And that money's got to probably last for 45 more years.
If I had kids and I felt like I wanted to be there for them, sure, why not? I think the math works, is what I'm saying. Now, on the other hand, I think at age 45, he may do this for a few years and realize maybe I want to do something else, and that's okay too. Basically, the question is, can I if I want to? And I think he can.
I don't know if he can or not. I mean, the number makes sense, but I don't know how long that money's going to last, depending on, he's not working 2% plus tax. He lives in Jersey. They got 3 kids. He's spending $10,000 a month now. He's got $500 in a 529 plan. I don't know. It let's say
Yeah,
the market tanks, he doesn't manage it correctly. Now he's pulling 3% out, taxes go up. I think it's rich. At 45, I would not want to be pulling 2% out of my portfolio, but
really, I
that's just
disagree with
me.
that. I think that doesn't even include Social Security and
At age
pension.
70,
I know,
that's
but
25 years from now. Who knows? He's probably not even going to be there.
I say try it.
I think he's got, well, the guy's making $350,000 a year. Can he get a job making 50 grand? Do something online, work, a couple hours a week. So
I well,
six
I
to
do
10,
think
they're in school during the day anyway.
I do
Is he going
think
to
so.
homeschool them?
So, well, not even considering the financial part. What's he going to be doing? And that to me, that's the second question that he didn't ask, right? Which is, I mean, he asked, does it make sense financially? But you and I know that a 45-year-old, and you and I are both past that, right?
Not by much for me. I'm just putting him in my shoes. So let's say I'm close to 45 years old, and it's like, all right, and I have two young kids.
Yeah.
I have one that's 3.5 and one that's 9. So it's like picturing me retired with the kids, taking 2% out of my portfolio. I think that's a lose lose.
So, Joe, would your thoughts have changed on this before you had the kids?
No, I just think 45 is too young and 2% burn rate. I mean, I think it's rich. I think the math is flawed. I think a good distribution rate for someone that is in their 60s is probably 3. The 4% rule, I don't know, given so many different studies that have come out, I think it's a good like gauge to see how much money that you have. They've saved a lot, but I don't know. I think that's to me, I would never do that. That would be a little bit too rich for me.
Well, I wouldn't do it either, but for the for the secondary reasons that you talked about. As far as financially, see, here's what I think like may happen. I'm not going to predict, but what may happen is he does this for a few years. He starts to see his portfolio start to change. Now, 2%. I mean, if a portfolio over time, a globally diversified portfolio would earn 6%. Now, there's no guarantees. What if it loses 10% for 5 years in a row? How is that going to feel? And I think that's what you're getting at. And that's a valid concern. And if that happens, then it's like, well, heck, maybe I'll just go back to work. But I think the numbers are close enough that he can try it.
He's looking at his statement and he sees $3 million and he feels pretty good.
Yeah.
How about if that goes to 2.2 million?
Well, then he goes back to work.
Right. It's like, oh, he's got a good job making, 350 grand a year. Yeah, you're right, Al. I mean, if we looked at just kind of this in a bubble of, hey, take 2% out of the 3 million, that's going to cover the shortfall, pay a little tax. Um, it's close. But at 45, this money's got to last. $3 million is a ton of money, but it has to last this family for probably another 40 years.
Yeah, a long time for sure. At least 40.
But she's going to continue to work, but she's not going to save. They're going to be so. I don't know. I mean, go for it. I guess. Yeah. If you want to take care of the kids, you want to homeschool the kids. You're burnt out. You've done $3 million at 45. You're in the top 0.01% of people. And so you've given yourself the luxury to do something like this. So what the hell, right? And
Yeah,
I'm sure if he's making 350 and he's got $3 million, he's marketable. In a couple of years, he could probably get a job pretty quickly.
I would expect he's got some skills that people might want. It's kind of Joe, it's kind of like the fire movement. Those people retire sometimes in their 30s, and then they end up doing blogs and YouTube, videos, and they make a lot of money that way. You're probably right. He'll probably want to make some kind of money, but I don't think he necessarily has to, certainly at the beginning. I think he has to see how it feels and see what happens to the portfolio. It somewhat depends upon what the market, like if the market corrects over the next 2 or 3 years, it's not going to feel very good. And I think that's what you're getting at.
What I haven't heard much of the old fire movement lately.
No, not me neither. It's still out there, I'm sure.
Financial independence, retire early, right?
Early.
Oh.
Yep, that's it.
Yeah, people would live in their mother's closet,
So they saved 80% of their income.
and save 85% of their take home. They eat spam every day.
Yeah, that's right.
Have you ever heard the term no regrets? It's a good way to live your life, but unfortunately, plenty of retirees have plenty of regrets. This week on a brand new episode of Your Money, Your Wealth TV, learn from their mistakes. Joe and Big Al show you how to avoid the 10 biggest retirement regrets and to set yourself up to retire happy and secure. They'll also share retirees' recollections on everything from lending money to boredom to give you the wisdom of the ages without having to learn it the hard way. Then calculate whether you're on track for retirement for free. Input your current cash flow, assets, and projected spending for retirement into our financial blueprint tool. It'll calculate a detailed report with 3 scenarios to help you determine your probability of retirement success with actionable steps you can take now to achieve your financial goals. Watch 10 big retirement regrets to avoid and calculate your free financial blueprint. You'll find the links to both in the episode description.
All right. Here we go. Let's go to the next one. This sounds very similar. This guy's burned out too, Al.
Okay. We got a theme going.
I think I'm burnt out. This is actually me.
This probably was you. You changed the name, didn't you? Or yeah,
I love
burned
the
out.
show, Joe, Big Al. Stumbled
Oh, yeah,
across
Joe
your...
wrote this.
Yeah.
Because
I love your show,
came
Joe.
first.
So he stumbled across our podcast this year, hoping for a little spitball, looking to retire next year. I'm 42, single, live in New Jersey. Is this double New Jersey?
It
I
is.
think people are just getting burnt. It's winter, it's cold in Jersey.
Yeah,
They're like,
they
you
don't
know
want to be
what?
going to work.
I'm done. He drinks a little Stella in the summer and apple cider in the winter. Net worth $2.25 million. Good for you. Jeez. He's got a 401k of $1 million, Roth IRA of 150, brokerage account of 400, cash 700, earnings makes $100,000 in interest and dividends is 40. He's got $40,000 of expenses. He's working in a toxic office and trying to see if I can afford to retire. See, I'm with you.
Is your office toxic? Really? It's
Yeah.
that bad?
I feel that. Well, that's why Big L's in Hawaii. So let's see. Here's his plan. All right, this is good. I like people that he's formulating a plan, a strategy. He's like, all right,
Right.
age 43 and 51. He's going to have $50,000 expenses. He's going to have another $10,000 for insurance. He's got a drawdown from $700,000 cash, CDs, and bonds. All right. Age 52 to 62. He's going to have $80,000 in expenses. He's going to draw down his brokerage account, assuming a 4% return, now worth $600,000. All right. And then at age 62, he's going to have $100,000 in expenses. Drawdown, he's going to have a $15,000 pension, $14,000 from Social Security. Then he's thinking his 401k and Roth IRA will be worth $2.2 million by the time he's 62. Does this work? All right. He planned to regroup and spend some time volunteering. All right. So the other guy wants to take care of his kids. He wants to volunteer, take care of other people's kids.
I like it.
Cool. 42. Guy's got $2.5 million, single. What do you think? You like this plan, Al?
Well, I'll break it down. So if he's spending 40,000, which it's pretty hard to only spend 40,000 in New Jersey, I would think, but let's just go with that number for the time being. He'll have an extra 10,000 or so, he thinks, for insurance. So that's 50 grand. You divide that into about 2.3 million liquid. That's 2.2%. Our last one was 2, just a little bit higher, but it's in the ballpark. If let's then go forward 8 years, because that's what he's saying. 8 years from now, So it starts with 2 million, 8 years from now. He's drawing 2.2%. I don't know what it's going to grow. I just said, what if he only gets a net 2% growth? Just to throw in a number. Okay. And then he's pulling out, 50 grand per year. He actually ends up with about, I think, 2.7 million. If I did that math right. And then he's got about a 3% distribution rate if he's wanting to spend 80 into 2.7. That's kind of on the margin in the early 50s, but it's not that far out of whack. So, and then by the time he gets to 62, he's spending a little bit more, but he's 20,000 more, but he's got 30,000 more of income based upon his assumptions. I think it's potentially doable. To me, it's a little bit tighter than the last case, but it's it's possible. And we'll say some of the same things again, which is if the market does well and cooperates, I think he's going to feel good. If it doesn't do well and we have some pretty big corrections, he'll probably want to go back to work.
Yeah, he's going to pull roughly $1.2 million out of his $2.2 million before he turns 62.
Right?
So over half of his liquid portfolio is going to be gone before he's even full retirement age.
No, no, no. That's considering no growth, and that's not reasonable.
I don't. Well, what, I think you're way too optimistic.
A
Have
two
you ever heard
percent
of the
growth.
lost decade? Have you heard of the lost decade? How about if he's in the S&P 500? What did the S&P 500 do for that 10 years?
You didn't listen to what I said. I said if you go with a 6% average return of a globally diversified portfolio for
I
the
don't
last
know. How about if he,
hun-
but I think you can't assume that at 42, can you? If you're pulling that much money out?
of course not. But if you go with just basic mathematics, it's pretty close. The problem is the sequence of returns, right? If you have let's say there's a lost decade, right? And there's no rate of return for the 10
Right.
years, which is what you came up with. I think in 5 years you're going back to work because you're just seeing your portfolio just get decimated. So yeah, 100%. In fact, that 2.3 million, you're pulling half of it, plus it goes down 20, 30, 40%. Yeah. Any reasonable person watching this would then go back to work, right? So I'm not saying it's guaranteed, but I'm saying it's
Sure.
it's 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 close.
Yeah, I think on paper it's a lot easier just to kind of run some of this stuff, but in actuality, there's no way. I don't think this is even close to reasonable, just because if he has to be at least 60% in stocks, would you say to get a 6% return?
Yeah, I would.
Right? So at least 60% in stocks, and let's say, and then the other 40's in cash and bonds. If cash and bonds do 2 to 3%, right? Then you have inflation running that 2 to 3%, and then the stocks go down. Now your distribution rate is not 2.5; it's probably 4%. I mean, I just think there's so many different moving parts here for such a long period of time, and I think that's the problem with like financial planning calculators. I think that's. I knew I probably shouldn't have done the show today. I told you I'm hot, tired,
You're
spicy,
hot.
but
That makes for a
I,
good show. Come on now.
but no, I think it just gives people false confidence a lot of times. All right, well, here I'm going to plug it into. Who was the guy that was like, "Hey, well, I plugged this thing into the financial, the Fidelity financial planning calculator or whatever, and it said I was going to
Yeah,
be great." And then
yeah,
you and I looked at it. We're like, "Yeah, I don't know." I
right.
mean, it just depends on what assumptions that you put into this. So we're assuming, okay, a 6% growth rate, that is a straight line growth rate. Right. Well, you're not going to get a straight line 6% growth rate. You're going to get 20%, then you're going to lose 10, and then you might get 4, then you're going to lose 20, then you might get 25. And then as you're pulling dollars from these accounts, plus he has most of his money in a retirement account, and so he's going to drain 100% of his brokerage account to zero. That's going to be hard to do. You're going to see that pool of money just go from X amount to zero. Psychologically, I think it's going to be challenging for him to pull it off. But if we look at it again, if I plug this into a financial planning software, it will probably say yes, or like a Monte Carlo. It might say, yeah, you could probably do this.
Well, if you look at his brokerage account and cash and CDs, it's currently 1.1 million. So if we use your
Yeah,
math,
right.
right? So basically he's going to spend that, assuming zero growth, right?
Sure.
Yeah. So he can do it. He gets to 59 and a half before then. So then he could pull from retirement accounts. I get your point though, Joe. And your point is the longer the time period, there's more chance for uncertainties and things that could happen that are not in your favor. And although it could go the opposite, we could
Oh,
have some real
totally,
good,
totally.
really good markets, and then you're thinking, why didn't I retire at 38? Right?
Exactly. Right. It's going to show, you know, he plays this thing out and then he's got $5 million and he's like, all right.
Right.
Or
Yeah.
he's going to play this thing out and he's broke by 55.
Yeah, so I think when we're talking about such a long time frame, so in both examples, I was kind of doing the straight mathematics. The reality, though, behind it is you have to react to what cards you're dealt based upon the market, based upon what you're really spending, right? And you may have to go back to work when you're retiring this young. It's just the reality of it. Or you may need to work part-time if you start seeing your money slip away, particularly in a bad market.
He's done such a great job. He's 42 years old. You got $2.2 million. You could work another 8 years.
Yeah, but it's toxic.
Find another toxic environment. Uh,
He
well,
needs he needs he needs to come live in Hawaii with me. He'll be much more relaxed, and
oh,
then he could
yeah.
keep working.
Well, that's going to
Zen.
really cause his expenses to go up.
Well, that's true. Good point.
As promised back in episode 511, the 2025 Key Financial Data Guide is now here and ready for you to download for free from the episode description. Joe and Big Al use it daily themselves. It lets them see at a glance the 2025 tax brackets, capital gains tax rates, retirement plan contribution limits, tax on Social Security, Medicare premiums, and current credits, deductions, exemptions, distributions, and exclusions. All the numbers that affect your financial strategies as you plan for retirement. Just click or tap the link in the description of today's episode to download the 2025 Key Financial Data Guide for free, courtesy of Your Money, Your Wealth, and Pure Financial Advisors.
All right, let's keep going here. We got Suzanne from Massachusetts. I drive a 2016 Lexus 350 GS. All right. Dry red wine is my tipple of choice.
You ever use that word before?
Tipple?
Tipple?
No. That's the first time. I didn't even know how to read it.
I never use that either.
Andy, is that what you use?
It officially means drink alcohol, especially habitually. Ooh.
Oh,
Ooh.
that,
All right.
maybe you should know that word, Joe.
Oh, wow. Shots fired. I'm
What's
69.
your tipple, Joe?
Yeah, a little tipple, my tipple of choice. Who's the lady that wrote in and was like, man, I'll drink everything, even gasoline or something.
I don't remember that one.
I'm 69 and work in healthcare on a per diem basis. I make $40,000 a year. I plan to draw Social Security at age 70. Estimated benefit is $48,000 a year. I have $1 million in retirement savings with a mixture of annuities. I rent and have a small emergency fund of $100,000. I need $55,000 to $60,000 a year for the next 30 years. Am I all right?
Her emergency fund is $10,000, and her
What'd I
retirement
say?
savings is in annuities and 401k. You said $100,000 emergency fund.
Okay, she's got 10 grand. She needs
Yeah,
60
well,
grand.
so we've got $1 million in retirement.
Yeah, she's going to have $50,000 in Social Security benefits. She needs 15,000 from $1 million, 1.5 at 69.
1.5%.
I'm good with that.
Oh, you're good with something. I'm good with that too. But what if she lives to 110?
She's still fine.
That's no different than a 42-year-old living to 80.
Yeah. 42-year-old. Well, by the time the 42-year-old turns 80, the life expectancy, there's going to be a magic pill that you're going to live until like 150,
A good point.
according to your boy.
Yeah, my boy.
You know what I'm talking about.
I know you're talking about.
Uh, okay. So are you, do you agree with me, bud?
Yeah. Yeah, of course. I'm good with this.
All right.
1.5% distribution rate at 69. Yeah, it looks good.
Okay. Good job.
Yeah.
All right. We're just going to keep plowing through here. We got Maryland Chicken Man.
Okay.
We're a little late on this one. Happy Turkey Day, Joe, Al, Andy. Oopsies.
Whoops. Yep.
Well, it just goes to show how many people have been emailing us.
I've been listening to your podcast since the beginning of 2020. I work alone on my chicken farm every day, so I listen to online books, and your podcast keeps the boredom at bay. I knew that my career wouldn't make it until 59, so I started investing into a brokerage and traditional IRA early in life. I'm 45 now and as good as married, but not legally. We have no kids, and we are not going to in the future. Just a spoiled 10-year-old lab, and we have expanded a puppy family. I estimate in 3 years, my contractual job will end as I would have to upgrade my infrastructure to continue, and the return on investment wouldn't be worth it. Never did like it anyway.
Another toxic workplace.
Toxic. So here's the breakdown. He's got, let's see, a couple $1 million, it sounds like. $1.7 million in a brokerage account. He's got an IRA of 100 grand, solo 401k of 100 grand, Roth IRA, 8K just opened. He's got 2 rental properties worth about 450, not going to sell, as they're next door to me. They profit $15,000 a year. Business assets are land worth 500,000, which I'll be happy to sell, but not right away. Zero debt, and not going to get any. My income is $100,000 a year. I max out my solo 401k of about 40,000 a year. Roth IRA is 7,000, HSA 4,000. After my job ends, I'd like to withdraw an amount to get to the top of the 12% tax bracket, or to get to the top of 12%. FIFO on the brokerage is 170% earned. FIFO on the brokerage is
I think
170% earned.
I think what he's saying is,
First in, first out.
yeah, well, yeah, first in, first out, but I think what he's implying is that most of the brokerage was growth and earnings. That's all I can that's all I get from that.
He's got 170% rate of return
No, no,
over the years, a
over the
cumulative return.
well, and I suppose you could look at it that way, yeah. So if his account was whatever, 300,000, 170% is earnings and the rest, I don't know. Who cares? Who knows?
All right. He's not a fire guy, but I love FI, financial
Financial
independence.
independence. Yeah.
Okay. I would like to use up the assets potentially because I have no heirs. $80,000 withdrawal per year is what I'm looking, plus uh, $80,000 withdrawal per year is what I'm hoping for, plus the 15,000 for the rentals. Question: if I never earn another dollar, how much can I withdraw every year? What would be the best strategy to do so? Just a spitball, please. I drive a Silverado and a top-off Jeep Wrangler. I like Coors Lights, Sam Adams, and occasionally a little vodka and pineapple over crushed ice. Make up a funny name for me, please. Don't
That's
worry,
why
I
he
won't
got.
stop listening if you don't answer my spitball.
That's why he got called Maryland Chicken Man.
The Chicken Man, Maryland Chicken Man.
Tells you
Okay.
everything you need to know.
Maryland the
Okay.
Chicken.
So we got another person that wants to retire young, Joe.
If I knew this was a fire show, I wouldn't have shown up. Who
So
is
so
that guy? Cupert?
Yes.
Do you think he's broke?
I don't know. Let's see if Cupid is out there still.
was
No.
he the real estate guy?
Yeah, that just leveraged everything.
Yeah,
It was like 90.
Yeah,
he did Airbnb and all that, didn't he?
I don't know.
something like that. Yeah. Okay, so Joe, to recap, he's 45, he wants to retire in 3 years, 48. Got 1.9 million. I'm just doing the math. Don't before I answer, I'm just doing the math. So 3 years, 6% return. He's adding about 50K a year in his savings, 401k and Roth. He'd have about 2.4 million.
Yeah.
And let's say, like, what would be a distribution rate mathematically for for a 48-year-old? I'm going to say 2.5%.
Yep. I
So,
agree.
so,
It's
so
fine.
I get 60 grand, and he's got $15,000 from a rental. I think he can spend 75. That's what the math says. But then trying to think how you're going to respond to that. Yes, it depends. It depends on what really happens with the market. Retiring this young, there's a lot of variables that may cause you to have to go back to work if the market doesn't cooperate, or if you spend more than you think, or any number of things.
Well, this guy is, I think he's a little bit different than the other two
In what way?
because he's like a small business guy.
Yeah, but he
He
doesn't want
works
to
on a
keep working.
chicken farm.
He doesn't want to keep working because he's got to reinvest in the farm, and he got to be expensive, and he doesn't even like what he's doing.
Right. But he's working with chickens. He works on a chicken farm. He doesn't
Yeah,
have a cushy office job that's making, a couple $100,000 a year with a very toxic office environment. He's got a
sure.
toxic environment because the chickens are like
Have you ever worked
they
with
probably don't
chickens?
smell great.
That would be hard to work with chickens for 30 years,
Oh
wouldn't it?
man. But what I'm saying that he's got rentals, the debt is paid off, he's got cash flow, he's building assets that will give reoccurring revenue. I think if he did this, and I don't think he would do this. I think he's going to start another business. I think he would do another side hustle. I think this guy would do, different things, and I think he's capable. A lot of people can't build a business or do things I think like the chicken man does. If you work in an office and you have a W-2 job that made your skill, which is phenomenal, I think that's a skill set where you got someone that can kind of he's making a lot less money, mind you, but I think he might have a little bit more grit where hey, I don't want to go back to the office, but I'm gonna raise llamas.
Right. Yeah, and I'll feed off of what you just said, and that is people that are self-employed, you have good years, you have bad years, you've learned how to live within that, as opposed to someone that gets the same salary year in, year out, maybe a 3% raise or whatever. It's a little tougher to make those quick course corrections. So I
Yep.
I I I think I'm agreeing with what you're saying.
Oh, you think you are. All right.
Yeah.
Okay, so to address the question of whether or not Kubert retired, he apparently did in June of 2023, and he
That
is
was
Okay.
his
still
last blog.
no, he is still blogging. His most recent one was December 27th, and it says retiring early. Better get familiar with Roth conversions.
Well, he's
Oh,
probably still a big fan of the show.
I bet
yeah,
so.
probably. I think we're done, right, Joe?
Yeah. You know what I did? I went ice skating with my kids.
Yeah.
Were you actually
That
on
I,
skates?
I was on skates, yes, but it wasn't ice. It was plastic.
oh, really? That was
Yeah, I
probably
was at
weird.
the hotel in Del Mar. So we had dinner. It was nice. Kids wanted to go ice skating. I'm like, I'm from Minnesota. I can ice skate. Guess what? I
Not so much
cannot
No.
on
ice skate.
plastic.
I cannot ice skate. I took a header. I hit the
Oh
ground
my.
so hard, and I bruised like 3 ribs.
Oh no.
Wow.
Oh, I've been miserable for like 2.5 weeks. I can't sleep.
Jeez.
Playing golf, I was like, hey, we got some time off of work. I'm gonna play golf every day. Nope.
No, no. Well, that's
So
too bad.
yeah, so I got an excuse for being a little ornery today.
Ice
That's
only
all
next
right.
time, Joe. Maybe
It,
you need
it,
ice
it,
on your side.
it makes for a better show, I think. Just keep getting injured.
Yeah, sounds good. All right, very good. Thanks, Al. Thanks, Andy, and have a good trip, Al. Be safe in Australia and New Zealand and everything
Yes.
else.
I'll be back in a couple weeks.
Yeah, we'll see. Well, probably a month.
Yep.
Okay, we'll see you later.
Listen next week for more Spicy Joe as the fellows spitball retirement for Mike and his wife in Tampa and for Kate in California. They'll also answer some questions from our YouTube viewers on Roth conversions, tax planning, and gold. Do us a favor and help other people find YMYW. Leave your honest reviews and ratings for Your Money, Your Wealth and Apple Podcasts and all the other podcast apps that accept them. Listen or watch us on Spotify or YouTube and meet me in the YouTube comments to join in the conversation. You'll find all the necessary links in the episode description. If you're worried about outliving your retirement savings and wondering if you're on track, get a free financial assessment from the experienced professionals on Joe and Big Al's team at Pure Financial Advisors. They'll go beyond a simple spitball to give you a comprehensive analysis of your entire financial picture and your risk tolerance to help you create a customized retirement plan that aligns with your needs and goals. Click or tap the free assessment link in the episode description or call 888-994-6257 to schedule your free financial assessment either in person or online. Your Money, Your Wealth is presented by Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.